Well, good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacroix here in London. So traders have pared bets on Bank of England rate cuts to less than 50 basis points this year. Markets now expecting the first quarter-point reduction by November. Well, I'm very pleased to be joined by Grace Peters, Global Head of Investment Strategy at JPMorgan Private Bank, also joined by Andrade from Bloomberg Economics. So we'll talk about BOE and, of course, the investment case for the UK. And Anna, I know you're also looking at the BOE's Bernanke report. So Ben Bernanke was tasked with looking at communication skills. And actually that report, that much eagerly awaited report, finally comes out tomorrow. So why is the bank doing this?
It commissioned this external review to sort of fence off criticism of its failure to anticipate the biggest inflation shock in a generation. And at the beginning, that was what was intended, the Bernanke would look at the forecasting processes of the bank and see if there was something wrong with it. But we've wrote a lot about this, and we look at the forecast record of the BOE, the ECB, and the Fed, and we actually see that there's nothing particularly wrong with the BOE. The scale of the forecast errors was very similar across the three central banks and also close to our own forecast errors in the private sector. So what we think that the report will focus on, it's not so much on the ways to improve the forecast, because forecast errors are sort of inevitable in the area where we're in, but more on the communication of the BOE, because the BOE, I think one of the challenges of the BOE's communication is that it doesn't really give markets a say about what it thinks it's the right path for rates over the long term.
So how do you implement the changes? I know there's been a lot of talk about, for example, the dot plot, which, for example, Catherine Mann was really pushing back against that and saying, look, you have a median average, and actually it's much more transparent than even what the dot plot would give you.
Right now, how the bank communicates what it thinks about the rate outlook is that it produces two forecasts. One forecast for the economy and inflation based on the market path for rates, and one just assuming that rates stay unchanged over the next 3 years. And we have to sort of deduct from those two forecasts what the BOE is thinking that is the appropriate forecast. And as you can imagine, it's sort of unnecessarily complicated. So we think the single best recommendation that Bernanke could do is to suggest that the BOE changes into producing its own forecast for rates. And it doesn't necessarily need to be a dot plot like the Fed does. I think that will be operationally complicated. But it could just be something like the Riksbank does, where it produces a central base for the rates based on sort of a model and what's appropriate monetary response, also with some judgment. And so that will give us more clarity on what the BOE is thinking.
And I want to ask you whether you think these changes will take a while in a second. But Grace, would that be useful for you? As market participants, would it actually make a meaningful difference to how you evaluate monetary policy of the BOE?
I think it would be helpful to the market, because we've seen, using the Fed as an example, how that forward guidance is something that the market prices almost immediately. It's the forward guidance that can make its way straight through into market pricing across asset classes. So I think that would be a helpful development.
So if you look at these changes, how long will it take to implement them, whatever happens in that review or whatever we see in the review?
I think historically the BOE has taken its time to implement the changes. The worst review from 2014, the BOE sort of took 8 months to implement. Bernanke is not going to come out with just one suggestion. It's going to come out with a big list of suggestions, and the BOE will sort of choose what it wants to implement. But now we also know that Claire Lombardelli is going to be in task of supervising the implementation of the recommendations, and she's only going to start her mandate in July. So that means that it's definitely a question for 2025, and it will start way after the BOE, in our view, starts cutting rates, which is in June.
It's interesting because, someone like Mohamed El-Erian, who has given, frankly, the Fed hell, is really pro what the BOE has been doing in terms of communication, because he says, look, sometimes they just don't know, and it's refreshing and useful for the markets for a bank to say, we just don't know.
I agree, but I also don't think, and I think that's also why there's some resistance within the BOE into moving to produce a central baseline for the rates, because they're afraid that will be seen as a promise. But I think markets change view all the time, economies change view all the time, and the Riksbank, it hasn't hurt the Riksbank credibility to sort of produce this. So I don't think it would have adverse consequences.
Grace, what's your take overall about UK equities? So we're also in an election year, a lot could change, and yet both parties seem to say that they're quite friendly to business.
Yes, I think UK equities are actually one of the most unloved parts of the market, and it's been that case for a period of time. But when we're thinking about drivers of the UK, there's no doubt that the UK is starting to see a bottoming out of growth. The PMIs in the UK are actually some way into expansionary territory. And, when we look at, I know you were reporting on housing data earlier, there's quite a few signs that the UK is improving, which would be good for the domestic parts of the economy. And, of course, the UK equity indices is also very global. A lot of oil companies, with the oil price up where it is now, that's helpful for their earnings and dividends, and mining companies as well. So I think for those looking for unloved and contrarian options, the UK is quite a good place to look.
Just the bigger companies, or there was always a question about the FTSE 250 and actually
Yes.
what kind of value that gave you?
I think the FTSE 250 is still very domestic, so I would prefer to be in the FTSE 100 where you get that mix of, yes, some exposure to banks and home builders that are domestic, but you get the international stream as well. A real kicker for me, if the FTSE 100 were to, what would be the catalyst for the FTSE 250, it would be an increase in M&A for some of these smaller companies, whether it be public-private or international buyers. That's always seen as a real sort of bellwether when M&A picks up. That would be a great catalyst to look at the FTSE 250.
And what are you expecting? I know there were, traders were pushing back for this full 25 basis points BOE rate cut to November. I mean, it keeps on being pushed backwards and backwards. But I wonder whether that's Fed, concerns rather than looking at what we're seeing domestically.
I think it's mostly Fed concerns. I think there's a big question now is, are we going to see a divergence in monetary policy between Europe and the US? I think we will. I think the story is different between the two. I mean, if you want to look at data, we can just start with the data. Data since the start of the year has surprised to the downside consistently in Europe. In the US, it has gone in the other direction. Core inflation, momentum of core disinflation is actually stronger in the UK than it is in the US. The 3-month on 3-month annualized rate is 2.5, we estimate. It's 4.5 in the US. And then history also tells you that the BOE doesn't always follow the Fed. It started hiking 6 months before. In 2016, it eased when the Fed was hiking. So, there's some concerns about the exchange rate channel that, if the Fed doesn't hike and the BOE doesn't cut, and the BOE does, that the pound depreciates and that can bring inflation. But the pound moves, or the inflation depends on a large basket of currencies. US dollar only accounts for 20% of that, so
it's quite funny.
Significant.
And the only question that Governor Bailey never answers is actually the gravitational pull of the Fed, which is what we were talking about, also in relation to the ECB. How much harder does it make it for the BOE because of some of the concerns you were outlining, especially sterling?
I think it makes it harder, and it doesn't. I mean, they probably would prefer that the Fed also start. It would make sort of the communication across the globe easier. But there are specific things to Europe that the US doesn't have. The energy is a massive source of disinflation that the US just doesn't have. And here in UK, we're going to see energy prices in the CPI falling by 12% in April, 8% in July. These are big movements. And also the economy is just weaker. It's just below potential, which is it never got to that point in the US. So if the policymakers focus on those areas of divergence, I think they can still communicate effectively.
And Grace, you mentioned M&A. Do you think there's also a pull from investors, given the UK seems relatively stable, maybe compared to other democracies right now? Are we going to see more money into the country, or is that vacancy?
We hope so. I think I mentioned before it was more of a contrarian and unloved place, but it's also a location with an absolutely super capital market. So we really very much hope, and I think the early signs are that M&A is coming back broadly and that the UK will be included within that.
Thank you both for joining us. Grace Peters there from JPMorgan Private Bank and Andrade from Bloomberg Economics. Now, coming up, we'll be discussing the future of the City of London and its role on the global financial stage with Javier Blas. More on that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, ever since Brexit, the City of London has been worried about its declining role in global finance. Now, those concerns came to a head when the London Stock Exchange failed to win last year's biggest global IPO, that of chip designer ARM, which happened to be British. Now, there are also fears of existing companies looking elsewhere in search of higher valuations. Well, Shell's chief executive says he's looking at all options for its listing. Now, let's get more on this story with Javier Blas, our columnist for Bloomberg Opinion. Javier, I'm so happy to have you on TV because, first of all, you know these chief executives personally. So when the chief executive of Shell says, look, he's looking at all options, is he really thinking about leaving the UK?
I think that we need to take, while someone has been about a year, a bit more than a year into the job at Shell, and I think that we need to take him very seriously because I think he means it. He is making very clear that his first priority is to fix the company, and he's embarked in what he calls a sprint of cost-cutting, of shedding units that they are not performing well, as reassuring investors that delivering dividends is his biggest priority. This sprint started in June 2023. We are about to be, and it lasts 10 quarters. So by the middle of 2025, we're going to know whether the sprint is working or not. And he says, I think that this sprint is going to help us a lot in terms of valuation. But if it doesn't work, and we have done it, and still we see a valuation gap with New York, then all options, and he repeated to me on the interview, all options need to be on the table. And my question to him when he was referring to all options was, are you prepared to take the shares from London into New York?
And his answer was?
All options are on the table.
All options. So that
I mean, at the moment, the priority is to fix the company. I don't think it's an issue for 2024. But when a CEO of a company the size of Shell, and that's the largest company on the FTSE 100, goes on the record and says that all options are on the table, I don't think that anyone should think that he's bluffing.
So you spoke to him in Houston. Why does he think there's a problem with the UK? Again, when you speak to a lot of chief executives, they say, look, it's coming back. Maybe there was a problem with Brexit. Maybe the capital markets was not as mature. But this is something else.
It's completely something else. I mean, I don't think that Brexit has generally helped, London PLC, if we put it that way. But here is that just in Europe, he finds that investors are not interested in fossil fuels for a number of reasons. ESG, climate change is one of those reasons. And he looks at different metrics, and it doesn't really matter what metric one chooses to look at between American-listed companies and European-listed companies. But he, for example, looks at the yield on free cash flow. Shell is trading, I checked this morning, around 12%. Exxon is trading around 6.5%. The lower the number, the better. And then you look at, you could say, oh, well, Shell has its own problems, but look at year-to-date performance from Exxon, up about 22% on the New York Stock Exchange. Shell up 11.5% year-to-date. There is a big difference. And you could say, well, the business perhaps of Exxon is a bit better than the business of Shell. But I think that the difference is too large to explain use on simply the business of Exxon is better.
So this is a free cash flow yield. And basically, the higher the yield, as you say, the lower the stock's valuation. So why is BP at almost 16%? Is there a problem with the business?
I think that, look, the European, particularly Shell and BP, for the last few years have been trying to serve what I say two masters. They have tried to achieve the center ground in global oil. And the center usually works very well in politics. That's where more votes are. But for big oil, European big oil, and particularly BP and Shell, because Total in France have opted for a bit of a more nuanced strategy. But you look at Shell and BP, they try to be a collection of oil and gas and then some renewables. For investors who were concerned about climate change, at the end of the day, they were still fossil fuel companies. They didn't care about how much they were investing in wind and solar. They have an oil and gas business. They will not invest there. And if you were an investor who were interested on fossil fuels because you see a future for oil, and also you see even if oil demand peaks, you see the amount of cash that these companies can generate, you don't really want them to spend money on wind and solar, which are low-yielding businesses. So they were not really interested. And at the end, they tried to serve two different masters and got none.
But so how difficult would it be actually take Shell, take it out of the FTSE and put it on New York listing?
Very difficult, because, I mean, and this is also very important. This is not the first time that Shell have looked at this. We knew, because, you know, executives talk in private, etc., but this is, I think, the first time that while someone went publicly on the record and say, of course we look at this. In 2021, 2022, Shell relocated his global headquarters from the Dutch city of The Hague back into London and ended the dual listing structure with a primary listing in the UK. And at that time, the company looked at, what if we don't just go from The Hague to London? What if we go from The Hague to somewhere in America? Both the headquarters, but also the primary listing. At that point, the main concern the company had was, I don't know if we have the investor support for this. We need 75% of the votes, and 40% of our shareholder base is in the UK and Europe, continental Europe. It's going to have the same problem if it comes in the future. I mean, how many shareholders in the UK are going to vote for a relocation to New York? Big question mark.
Javier, thank you so much. Javier Blas, columnist for Bloomberg Opinion, actually stays with us. Now, be sure also to subscribe to Bloomberg's In the City podcast that I host along David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. We have plenty more to come, and this is Bloomberg. Welcome back to Bloomberg UK. We're back with Javier Blas from Bloomberg Opinion, who's still with me. Javier, we're talking, I mean, you have a terrific piece out today that basically says what we should worry about, or what UK policymakers should worry about, is not really gain too much market share, is just not lose any, because you say there's a real possibility after your interview with the Shell chief executive that all options are on the table, including a listing to New York. I mean, what does that mean? If someone like Shell decided to move to the U.S., do you have BP, Rio, and all the other commodity companies leaving the UK?
mean, the natural resources sector has been always a staple of the FTSE 100. The London Stock Exchange was in many ways the kind of the great capital raising place to finance projects of natural resources, whether it was a copper mine in Chile or, the trade of oil with the Far East many decades ago. And now that is going to be in question mark. I mean, you have Shell, largest FTSE 100 company, opening the door of potentially moving. I mean, I say potentially. If that was to happen, the pressure on other natural resources groups that they are not really favored by investors, I think it will be very strong. I mean, if Shell moves to New York, would not investors be asking why is BP still in London? I know BP perhaps have a more attachment to the UK. After all, was British Petroleum. What about Glencore? It has a massive coal business. The company has said that if they spin off the coal business, the listing of that business will not be in London, it will be in New York. Can it happen that actually they don't spin the coal business, that they just relocate the primary listing of Glencore out of the UK into the US? I think that those are important questions, and those are Shell, BP, and Glencore. Those are three of the top 10 companies in the FTSE 100. We are not talking about a small startup IPO choosing the Nasdaq rather than the LSE. We are talking about three of the top 10 largest companies in London potentially leaving. And I think that the risk is a lot higher than policymakers and exchange executives seem to appreciate.
I mean, we had a conversation with, the chief executive of the LSE with a number of things that they're trying to put in place because of a commission looking at how you attract talent, how you attract capital markets and investment. Is there something that they could do now to make sure that the companies stay here? Or maybe, we're in an election year. Is there something that the government can do now?
I mean, I think that a lot of our pension funds and invested in companies that they are from overseas, so trying to tweak taxation in a way that is more positive for people who are saving for their pension to invest in the FTSE 100 that are putting it in, say, global indices. I think that could be a step on the right direction. But there is a big problem for the exchange because a lot of this is not about, there is a problem with the exchange. This is about the attitude of European investors towards fossil fuel industry. It's simply very different to be here in Europe, and particularly in continental Europe, where some pension funds have said, sorry, but we are not going to invest in fossil fuels, period. That's very different to when you go in Houston.
But so some, Javier, would say, well, good riddance if you can make up for it with other companies.
Absolutely, that could be. But the problem I see for London is where are those other companies coming? Because if you are not really attracting new IPOs from, say, the startup because they prefer the NASDAQ in New York, and you are at risk of losing your traditional big industrial conglomerates very heavy on fossil fuels, what's left?
I mean, are there renewable companies? Are there enough? Again,
I don't see that. The profitability of those companies is not there. We are not seeing a lot of interest for investors. I mean, some of the renewables companies in Europe have had a really terrible 12, 18 months, and you cannot really run a stock market just based on supermarkets.
Well, because they're quite small. I mean, that's also true, unless you really like to buy cereal and bananas. But is there anything? I mean, is there any renewable company that could rival, for example, a Tesla or an EV maker?
I don't see it. I mean, the big renewable companies perhaps could be coming from the automotive industry. I mean, we do have some national champions in Europe on the renewable power. I mean, I'm thinking of companies like Enel in Italy, Iberdrola in Spain. Those are big companies on those particular home markets. But I don't think that we have anything the size of Shell. I mean, this is the largest FTSE 100 company. It's very difficult to replace that.
Javier, thank you so much. As always, so exciting to have you on TV. Javier Blas, a columnist for Bloomberg Opinion. Now, another reminder to subscribe to our podcast, In the City. It's out today. This is Bloomberg.